Okay. The last part I want to talk about during this last hour before lunch is I now want to move into the investment real estate side. And I'm starting in your notes where it says tax deductions that apply during ownership of investment real estate. Okay, my little pre-warning before we start. Some of this stuff I'm going to teach you through time, and then I'm going to bring you current so that I can show you what's progressed over the years. First thing I want you to understand is when you own a rental property, tell me what side of the wall I'm going on. Remember this little scenario? Way over there. Under what category? PIG. What did PIG stand for? Passive income generation. So I'm going under this category of PIG. Now, here's what happens. When you invest in real estate, all of your stuff happens on this side of the wall. The first thing you get to deduct is you get to deduct all mortgage interest. And unlike your home, there's no limitations. In other words, I taught you that when you buy a home in this country, you're limited to $1,100,000. When you buy a rental property, you can have $1 million loan, a $2 million loan, a $1 billion loan. It makes no difference. All of the interest is deductible on any rental property loan. But it's deductible from what?
Income.
From the income from the rental property. Okay, so I want to give you a real little example here. Let's say I decide to go out, I'm going to do that little plan I taught you earlier about buying a couple houses a year. And I go out and I buy my first house, it's a smaller house, and I rent it for $1,000 a month. Now I'm going to do everything annual. $1,000 a month would mean that I'm making $12,000 a year in rent. Let's say that I have a $100,000 loan on this property at 10%. Therefore, the interest on this loan would be $10,000. What I'm trying to teach you here is interest is deductible from whatever the rental income is. And in this case, we're deducting all 10 from the 12. Okay? All right. Then the next thing we get to deduct is we get to deduct all taxes and operating expenses. Okay, now, I assume we all know what taxes are. So here's my question. We know what taxes are. What's an operating expense when you own a rental property? Here, I'll help you. Is there anything else? In other words, anything you spend money on for that rental property becomes an operating expense if the purpose is for that rental property. Here's a couple examples. Let's say I go out and I buy my first little rental property, and I realize that I might have to go over there occasionally mow the lawn. Don't happen to have a lawnmower. So I choose to go out and buy a John Deere riding lawnmower with a 48-inch blade. Is that lawnmower going to be tax deductible to me as long as the primary purpose is for that rental property? Yes. By the way, can I park that lawnmower in my own garage for safety? Yes. Can I practice on my lawn? Yes. Certainly, as long as the primary purpose is for that rental property. And then what about this? I know those tenants are going to call me up once in a while, and I'm going to have to go over there and fix the property. I don't have any tools. I need hammers, saws, drills, radio arm saws, all different tools. I spent $3,000 in tools. Is that $3,000 going to be tax deductible to me against this property income? Yes. Yes. And then, of course, I have another issue here in Minnesota, and that is we get this white stuff normally during the winter, so therefore I need a snowblower. Is that snowblower going to be tax deductible to me? Yeah, and is it logical that I must blow up my driveway first before I can go over there and blow up that driveway? And then I have one more issue. How do I get the lawnmower, the snowblower, and the tools over there to that rental property? What do I need? Not a semi, but a pickup truck. Dodge Ram with a Hemi. Sweet, okay? All right, now, am I exaggerating? No. Yes. If all I own is one house, a lot of this would be an exaggeration. I could not deduct an entire pickup truck if I owned one house. I could deduct part of it for the actual mileage I use to drive to that house. But gang, if I own 10 little houses, could I have a pickup truck that I use just to service and take care of those 10 little houses? Yes. Okay, but now, in my example, what I'm going to do is I'm going to say that the taxes and operating expenses are going to be $2,000. So if we just look at the math here right now, I got $12,000 of rent coming in. I'm subtracting my interest of 10 and my taxes and operating expenses of 2. So right now, what am I at? Zero. I haven't made any money. I haven't lost any money. Everybody agree? But now watch this next part. This is unique to this country, and if you go to other countries in the world, a lot of them will not recognize this. But in this country, we get to take a tax deduction for something that's referred to as depreciation, or technically it's called the cost recovery system. And here's what it's about. In theory, when you buy a piece of real estate, the weather and the elements is wearing on that real estate, which will cause it eventually to fall down into the ground. Is that a fact? Yes. It's just not going to happen during my lifetime. But that falling down process is something that our government says we can take a tax deduction for, because we are losing value because the building is aging. So therefore the government lets us take a deduction for that. Now let me kind of show you how that works. Let's say that the building is a $100,000 building. Let's say that I'm going to say it's going to fall down in 25 years. It's not, because I'm going to take care of it, maintain it, and paint it. But I get to claim that. Well, if I do the math and divide this, that means I get to claim in my tax return that I've lost $4,000 a year in value. Now, here's the point I need to understand. How much money have I lost? Zero. I haven't lost a dime. But on my tax return, I'm going to report that I lost $4,000 because it's wearing out. This is what we call a phantom or fake loss. And I'm here to tell you right now that if you can have any type of tax deduction on your tax return, the fake ones are the best. Why? Because they don't cost you any real money. It's just something the government allows you to do on paper. So now watch the math of this. I'm now going to start with the 12. I'm going to subtract the 10 in real money. I'm going to subtract the 2 in real money. And I'm going to subtract the 4, which is fake. When I do that, my net result in the bottom is I've lost $4,000 on this property, correct? Now that's on paper. How much have I lost? Zero. Now, there's a name for this number. Since we call this a passive income generator, if on the bottom I show a loss, that loss is referred to as a passive activity loss. Or for short, we call it a PAL. Now I taught you something earlier and I want to see if you were listening. There's a little guy who walks along the wall here, and the little guy's name was what? Urs. And I said Urs had something around his waist. What did he have around his waist? Tool belt. And in one of those pockets he carried this jackhammer drill. And I said if you approach Urs in a certain manner and became his pal, he'd drill you a hole. Well, guess what? You got one. What's a PAL? It's a passive activity loss, where you go to Urs and say, hey, Urs, I lost $4,000, even though I didn't. Will you drill me a hole? Urs says, no problem, and he drills me a hole. I now take the $4,000 that I did not lose, and I bring it through the wall and subtract it from the income that I make on this side of the wall. So if I make that $100,000 or less, I now I'm going to subtract the $4,000 from it, and my taxable income drops down to $96,000. When the fact of the matter is I made $100, but I only pay tax on $96. Why? Because I got a little house that's falling down, when in reality it's not falling down, it's really going up. Now I don't know if you're getting this yet, but is this a good deal?
Yes.
You do not look excited enough to me. So I guess I'm going to have to bring you to the next level. The next level is we are not going to go out and buy one house. I'm just going to multiply the numbers. We're going to do my entire little plan that I taught you earlier. We're going to go out and buy 10 little houses. Watch what happens now. First of all, if we bought 10 little houses, we would be declaring that we have houses falling down all over Minnesota. We now multiply the numbers out. When I multiply the numbers out, because they're all the same, we are now going to have $40,000 worth of PALs. Keep in mind, how much money have I lost? Zero. I now take the $40,000 over to the wall. I say, hey, Urs, I lost $40,000 this year, even though I didn't. Urs says, I understand, I need a bigger drill bit. And he drills a bigger hole. We now take the $40,000 that we did not lose. We bring it to the wall and subtract it from the $100,000 we made from our job or career. When we do that, our taxable income drops down to $60,000 when the fact is we made $100. But we pay no tax on 40 of it. Why? Because we got 10 little houses that are falling down, when in reality they're really not falling down, they're really going up. Plus we got tenants paying off the loans on those 10 little houses. Now I don't know if you're getting this yet. But is this a good deal?
Yes.
It is, but
You just do not look excited enough to me. We're going to get to the yeah buts in just a minute, okay? Yeah, go ahead. Does who get mad?